You learn supply and demand, you mark your zones, and everything looks perfect. You see price reach your demand, you take the buy, and your stop gets hit. Later, price reaches your supply, you take the sell, and your stop gets hit again. Only after both entries fail, price moves exactly in the direction you expected. This isn't bad trading. This is institutional supply and demand. Price moves into a previously defined demand area where buying interest is expected based on past reactions. Orders cluster in this area because many participants identify the same location as a potential reversal. As price trades into this level, buy orders are filled immediately while protective sell stops are placed just below the area. This creates a dense pocket of sell-side liquidity resting underneath the demand. Price then pushes slightly lower, not because demand failed, but because sell-side liquidity below the area is required. That push lower fills resting sell stops, which convert into market sell orders. Larger participants absorb those sell orders as buy-side execution. Once that liquidity is consumed, selling pressure weakens and price is free to move higher. After price moves higher, attention shifts to a supply area formed from a previous move down. Sell orders accumulate at this level because participants expect resistance. As price trades into this area, sell orders are executed and buy stops are placed just above the supply. These buy stops represent buy-side liquidity resting above the level. Price then pushes slightly higher into that liquidity. The push is not continuation strength, but a liquidity sweep. Buy stops trigger as market buy orders, allowing larger sellers to execute into that flow. Once those buy orders are absorbed, upward pressure fades and price is positioned to move lower. Both failed trades occur because price needed liquidity from both sides before committing to a directional move. The sequence shows price collecting sell-side liquidity below demand and buy-side liquidity above supply before expanding. The expansion only occurs once opposing orders are sufficiently filled. Supply and demand is defined by execution, not by visual structure. The important information is not the boundary of the zone, but the behavior of price leaving the area. When price leaves with strong momentum, it indicates that one side overwhelmed the other. That imbalance creates inefficiency where price does not trade evenly. A valid demand area forms when aggressive buying causes price to move higher rapidly, leaving behind inefficient pricing. That inefficiency shows that sell orders were insufficient to slow the move. The origin of that move matters because it shows where buyers were willing to transact heavily. If price leaves an area slowly with overlapping movement, that behavior indicates balanced participation. Balanced participation does not produce reliable reactions because neither side demonstrated control. Zones formed from slow movement are often revisited and broken because they lack strong order imbalance. Retail-defined areas tend to align with obvious swing points where price paused or reversed clearly. These areas attract attention and participation because they are easy to identify. The more attention an area receives, the more orders accumulate around it. This increases liquidity but reduces reliability for immediate reversals. Institutional execution occurs after liquidity is made available. Liquidity is created when price trades through equal highs, equal lows, or tight consolidations where stops are concentrated. Once those stops are triggered, opposing orders are available for absorption. An institutional demand area often forms after price trades below prior lows and then expands higher. The expansion shows that selling pressure was absorbed and buyers gained control. The demand is not the lowest point, but the area where the expansion originated after liquidity was taken. An institutional supply area often forms after price trades above prior highs and then expands lower. The expansion shows that buying pressure was absorbed and sellers gained control. The supply is not the highest point, but the origin of the impulsive move down. The stop-loss trap exists because stops are predictable. Most participants place stops just beyond obvious levels. These stops become targets because they are guaranteed sources of liquidity.
Price does not move randomly into these areas. It moves because orders are resting there. When price approaches a demand area without first taking liquidity, it often continues lower. This happens because there are insufficient sell orders available for larger buyers to enter. Price must move to where sell orders exist before upward movement can occur. When price approaches a supply area without first taking liquidity, it often continues higher. This happens because there are insufficient buy orders available for larger sellers to enter.
Price must move to where buy orders exist before downward movement can occur. This explains why first touch entries fail frequently. The required liquidity has not yet been collected. Entering early places the trader directly in the path of the liquidity grab. The stop becomes fuel for the move, not protection from it. Proper zone qualification starts with identifying whether liquidity was taken before the zone formed. Equal highs or equal lows nearby indicate resting stops. A move that clears those levels shows that liquidity has been accessed. Displacement must be clear and decisive. Large candles and rapid movement indicate aggressive participation. The absence of overlap suggests that one side dominated. Weak displacement suggests hesitation and lower commitment. Imbalance appears where price leaves gaps or fails to retrace deeply. These areas show where price moved too fast to trade efficiently. That inefficiency often attracts future reactions because it represents unfinished order matching. Fresh zones are preferred because orders are still likely resting there. Each return to a zone reduces available liquidity. Multiple reactions weaken the area because orders are filled or canceled over time. Entry timing requires waiting for evidence of control. After liquidity is taken, price should show a change in structure that aligns with the intended direction. Higher lows after a sell-side sweep indicate buying control. Lower highs after a buy-side sweep indicate selling control. Lower timeframe structure helps refine entries because it shows how price reacts after the liquidity event. A failure to continue in the sweep direction signals that the opposing side has absorbed orders and taken control. Entering after confirmation reduces the chance of being used as liquidity. It sacrifices some distance but increases probability. The goal is alignment with execution, not prediction of turning points. Context frames all decisions. Trading in the direction of higher timeframe movement aligns with dominant order flow. Countertrend trades require stronger confirmation because they oppose larger participation. Premium and discount concepts help determine whether price is positioned favorably. Buying when price is relatively low within a range aligns with institutional behavior. Selling, when price is relatively high within a range, does the same. Session timing matters because volume changes throughout the day. Periods with higher participation provide the liquidity required for large execution. Outside these periods, price may lack follow-through. Risk management remains mechanical. A single invalidation point defines when the idea is wrong. Fixed risk ensures consistency across trades. Multiple re-entries often indicate that liquidity logic was misunderstood. Supply and demand operates through liquidity, not visual appeal. When liquidity is respected first, zones function as intended. When liquidity is ignored, zones become traps.